Hello, friends. We are pleased to announce the launch of HDFC Banking and Financial Service Fund. It's an open-ended equity scheme investing in banking and financial service sector. Banking and financial services consist of many subsector, many sub-themes like banks, NBFCs, HFCs, insurance business, which includes both life and general insurance, capital market business, which has many sub-themes within it like asset management companies, wealth management, brokerages, depositories, exchanges. And lastly, it also includes technology company which are offering services, which market calls as fintech. Friends, you will have one basic question: why invest in the banking and finance service sector? Banking and finance service sector, it's an old sector and still it's a sunrise sector. And why we call it as a sunrise sector, given the fact that last 2 decades, the sector has grown faster than the GDP. And the importance of the sector is also rightly reflected in the market capitalization of the sector. It has increased from 6% of total market capitalization in 2001 to 24% in 2021. This also clearly reflects that the sector has grown faster than the GDP. And this is one of the prime reason for one to remain invested in or to invest in this sector. Second, if you look at the sector has delivered very strong return over last 2 decades. It has not only given higher return than the broader market or most of the broader indices like Nifty 50, Nifty 100 or the CNX 100 index. It has given higher return than most of the sectoral index, which clearly shows that one need to invest in this sector. So to conclude, this is a sector, this is a sunrise sector. It has grown faster than the GDP. And despite its strong growth, its penetration is quite low. It has delivered higher return than most of the broader market across all time period. And given its diversity in terms of many subsector, many themes, it's a sector one need to be invested. Second question, friends, everyone would have is why is it a good time to invest in the sector? Banking and financial service sector consists of two broad themes: lending businesses and financial service businesses. Lending businesses, in the lending businesses, two things drive the stock return. One is asset quality, second is credit growth. Both of which today we are at the bottom. Gross and net NPA for the banking system is on a declining trend. Provision coverage has improved. Banks are well capitalized, and therefore that gives a very clear indication that the worst of the NPA are behind. And if one sees financial year 21, if one sees FY21 earnings of bank, it clearly reflects that even in a pandemic year or a COVID year, banks stress asset creation has been significantly lower. Stress asset means slippages plus restructuring, and this has been quite low. Similarly, if we see corporate sector profitability, specifically in the capital intensive sector like iron and steel, metals, power, textile, chemical, in each of these sectors, one has seen a very strong revival. If one look at India's listed companies' profit to GDP in FY1, despite a pandemic, it has grown, which clearly highlights that the corporate balance sheet are in a very strong shape. And therefore, we believe that worst of the NPA for the banking sector is behind. Second, last decade, our corporate credit growth has been weaker. One of the reasons has been corporate asset quality, and second has been weak private capex. Both of them are showing signs of revival. While NPA has declined, we are seeing green shoots of capex, and therefore we believe that credit growth from here on will improve. Historically, we have seen whenever credit growth improves and whenever the sector has lower NPA, the underlying banks or lending institutions has delivered very strong returns. And we believe this is an opportune time to look at the sector that we are towards the end of the asset quality cycle, and we expect the GDP growth to revive and therefore credit growth to improve. Last question everyone would have on the investment strategy of the fund. While the benchmark for the fund is Nifty Financial Service Index, for us, we would look at the entire universe of the BFSI space. This sector has many themes, a smaller subsector, and we would endeavor is to have representation of all the smaller themes or subsector in our fund. And therefore, the entire universe is an entire BFSI universe is we are looking at. We will categorize this universe into three large broad categories: compounders, turnaround stories, and new age businesses. Compounders are generally businesses which have consistent track record of profitability, strong management, good brand pool, parentage. These are companies which will give returns in line with the earning growth. Second part is turnaround stories. These are companies which are seeing turnaround in operations or where the outlook is improving, or are companies which are expected to grow faster than the systems. These companies will not only provide returns in line with the earning growth, but there is a case for re-rating and therefore will provide the alpha to the fund. And the third part of the portfolio will be the new age businesses. What are new age businesses? These are companies or sectors where the opportunity size is very large. So some of the capital market businesses or general insurance company can be a new age businesses. Also, there are many more new companies which are likely to get listed in the space, like the fintech companies. Uh, all this we heard in the media. All of these companies which are likely to get listed will be part of the new age businesses.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.